Okay, so today we're going to go over how to pick price targets, whether it's intraday or longer term. You know, one of the things we talk about here is we use a lot of the tools inside of Rocket Scooter to set stop losses. For example, SPY is trading down and it's BRSU. And I can see that if I was long the market from hedge pressure, I would likely want to stop if it falls against me. That helps me do the risk side of the reward to risk ratio. Well, how do we determine reward? How do we know how far something will go instead of this part that says where something won't go? How do I pick my price targets? I just typed in BLU on the scanner and I found something that's like right on hedge pressure. And Oracle is a now hedge pressure break. It can potentially go higher. Okay, cool. So my plan is I can long and have it go somewhere and long again and have it go somewhere. Number one, the first thing you ever do, you will look at the walls. Let's look at Oracle right now. And I'm still use Classic app just to make it easier to have them side by side. Let's do walls on the monthly mode. Again, the third Friday of the month is what goes in the box. No resistance, right? It's call, 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 call. Let's just put in unlimited. There is unlimited. Now, again, your reward is not unlimited, but your reward based on walls has no limits. So let's go to the next step, resistance. Number two, we call gaps. Gaps are very important because anytime you're trading between the all-time high and the all-time low, anything inside of there we call internal to the trend. External would be down here and up here where you have nothing to go by. External. For gaps, as long as you're trading internal, gaps are a great technique to find buyers and sellers as well. You can see that every single day there's high amount of opening volume and there's like a U-shaped volume distribution that spikes towards the end of the day. As a matter of fact, all days look like this. All stocks have high human activity at the start and usually higher activity at the end of the day. It's usually like this backwards J. And as a matter of fact, all stocks that gap down or gap up are satisfying these massive order imbalances where just shares get bought up or dumped to the market at the end of the day. And the morning has a shift in sentiment. So the gap up and gap down is to try to find a liquid spot to disseminate that imbalance back to the market. We dump to them, they want to give it right back to us. Is say that there was like a Monday that traded that volume J thing and that volume J thing. Say that Oracle was here trading one day, and then the next day Oracle gap down at the open of the next day. So clearly between that print, this massive volume spike here and this massive volume spike, the sum of those is likely a sell imbalance, okay? There's a lot of sellers, so the market maker dropped the price so they can buy from all the sellers. So if market's raising price, it's going to look for sellers, and clearly there's sellers at the sell imbalance at that closing print. So it connects with the sellers. The buyers find the sellers. So filling gaps is one of the most important things that takes place. That whole balancing act is satisfied day to day using gaps. Anything you're trading, the first thing you should ever do to a chart is you must always, always, always mark your gaps. The top of the candle is what price that stock closed at. Do we all see that? There's one on the downside as well. Right? This was a massive buy imbalance where we closed here, and this is now a red candle version. So now on the way down, let's look for some gap fills on the way down. This is obviously one right here. We open, gap down. Let's go to the hourly chart, and let me just demonstrate. You can see how the market spends a lot of time ping-ponging between these levels to satisfy those imbalances. Number 3 and number 4 are red lines and yellow lines. And there are videos on the Rocket Scooter website that will detail what those exploits are. And those are some of our best techniques that we do have as well. Red lines are a little bit more subjective, but an example is that, you know, you have a run like this. I'm just going to draw the red line. You have 2 of them for every run. You have a run length and an impact, and you will see them in those videos. And let's just assume that every kind of rally or run is going to have some impact red lines on the way up and the way down. So there are other balance points that you'll look for. So even if it's falling, it's not just the gap fill. There are some internal imbalances that take place off of this run as well. So if gaps are exploiting the discontinuity between close and open, Red lines are balancing the discontinuity or an imbalance while the market's open. There's still a buying spree throughout the day that is a net accumulation of a market maker short. If this gap is a burst of market maker short in one order, the final print, this is a gradual market maker short across the length of the day. So do you see how each one of these techniques is showing you where buyers and sellers are going to be? Markets are falling. Market makers are looking for buyers. And now do you see when markets are falling, you're looking for buyers? Last but not least, yellow lines. Yellow lines is one of the fan favorites here. And watch the video on those as well. Gaps and red lines are part of the internal mechanism of trading. Walls will show you resistances based on positions. What about external? Welcome to yellow lines. Yellow lines will forecast higher highs and lower lows outside. So now we have all bases covered. What do you do if the market's going to higher highs? Well, so this is where the S&P was breaking out to all-time highs, 46, 47. So these boxes that I drew are where the yellow lines were, and I just delete them after they fulfill. This is a technique that our bot in Discord will give you these numbers. Pretend these lines are yellow again. They're not red. This is all-time high. Do we all see that? So we can actually map out resistance targets, all-time highs with futures very easily. With stocks is different kind of a technique. But watch the yellow line video. It'll kind of detail on how this works. You will see sellers emerge as you get to them. Look at this, 2 p.m., right? This is even the closing print. No argument here that boy, oh boy, when you get that selling resistance, you guys like that? Pretty cool, right? This candle, look at that massive volume. You guys are like, what the hell is that? Exactly. It's rocket scooter is all about. Do you guys see the ping ponging between these levels that we show you external to all prices? This is all-time highs on the SPY. We've never been at 4,600 in the history of the S&P. So does everybody agree that you see pivoting action here? We are longing the market and longing the market and longing the market and longing the market. And the market makers are like, okay, I'm going to short. All right, I'll short some more. Okay, I'm going to short some more. Okay, I'm out of shares to borrow. Okay, can I borrow from you? Nope, I'm out. How about you? Nope, I'm out. How about you? Nope, I'm out. You're going to run out of shares to borrow and you can't short more than it's available. But what if you could, right? There's a point where you're shorting more shares than are available. Game stop, right? And so you get to places like that where you have extreme amounts of risk by being upside down because you can't even cover all of those shorts. So the idea becomes that you just put it in, it's like a spring that you are just stretching, 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 stretching. At some point, there is no more ability for them to trade against us. We can't have the market indefinitely go up. So it snaps back very violently. And what they do is they squeeze out longs and force us to sell back to them, and they buy from us to get their stuff back. So imagine it's like a pocket full of shares, right? They drain their shares and drain their shares and drain their shares and drain their shares, and they have to borrow and borrow and borrow and borrow, and there's nothing left to borrow. Then market becomes illiquid, and all they got to do is drop the price very rapidly of all these longs that came in and start squeezing them out really quick to force them to sell back to them so they can buy and buy and buy and buy and fill their cut back up with some shares. So they can continue to raise the price and again, sell to us, borrow and sell, borrow and sell, borrow and sell. So that whole entire effect has to do with how many contracts or shares are available in the float to begin with. And so you have to have that kind of procedure where at some point, they just can't short anymore to a bull market. They need somebody to sell to them so they can buy back and close out their short. And that's what this volume is from yellow lines. I love this video. I love going through this, but you can see as the market moves, it taps one and taps the other and taps the other and has big, massive pivots off of those. See this, that U-shaped is interrupted by this massive volume on that yellow line tap. These are redistribution points at all-time highs when you have no fibs, no trend lines, no nothing that you've been here before. It's the first time we've seen 46 in the history of ever. And so those are also pivots. So when I go to all-time, even this one, the top of the market was a yellow line. And there's a theory that the yellow line video goes through is that every single time the market has ever crashed or sold off from a high, it always sells from a yellow line. that is the catalyst that starts a sell-off. As a matter of fact, this particular yellow line sell-off at the end of the day is the highest volume candle on this entire chart where my mouse is. Over a month of trading, this particular selling, I think this might have been some kind of news event or something. But do you see right here that it's so powerful that it's that selling? We can calculate them in futures very easily because they're fixed margin instruments, and the bot tells you those distances, and how you draw them is in the yellow line video.